Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow in which we invest additional money on the first trading day of every week. They're the Dividend-Growth portfolio, which was started in 2022 and now has an annual return of 20.04%, and our high yield stock portfolio, which is an annual return of 21.72% per year. The high yield portfolio was started in 2023. On the chart, I've also included their benchmarks for comparison. The benchmarks are in blue. I recently started putting the list of dividend growth stocks we buy each Monday on a Substack newsletter. You can sign up for the newsletter for free. You can find the link to the Substack newsletter in our video description. Again, it's totally free to sign up for. I'm trying out Substack to see what it's like as a platform. I might eventually move my portfolios to it. And since I'm brand new to the Substack, the newsletter is nothing fancy right now, but should get better as I learn the platform. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students and I started last year as outlined in red, and now has an annualized return of 24.44%. It's one of our newest portfolios, and because it's 100% invested in tech stocks, it's our most volatile portfolio. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three portfolios are accumulation portfolios mimicking someone in their working years who is consistently adding to their investment portfolios. Next week, we'll also talk about our wide moat and capital light portfolios, which are also beating the S&P 500, as well as a potential sector rotation strategy. As a reminder, the portfolios on the right in the light blue square are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to read more about them if you like less frequent trading. And the website is beatthestockmarket.com. Later in the video, I'll discuss ways to potentially boost the return of our stock portfolios. But it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our dividend growth stock portfolio currently has 103 holdings, our high yield stock portfolio has 27 holdings, and our tech stock portfolio has 26 holdings. Now here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so I put it on Substack for free as an experiment to see if I like the platform. So far it's easy to use and it's turning out to be more fun than I expected. You can find the list of dividend growth stocks we're buying on the first trading day of each week either on Substack or on my website, beatthestockmarket.com. Now you can find most of the strategies on my website. But if you can't afford it, each week for free I've been detailing the dividend stocks we've been buying in a YouTube video. I should say every other week. And then I feature the tech stock portfolio the next week along with the wide moat strategy and the capital light strategy. Now Substack has a notes feature which are free for anyone to read. And I've been posting our wide moat and capital light stocks that I've been buying. If you're interested in that, sign up for free on Substack and feel free to leave me a comment to let me know to post either the list of the capital light stocks we buy each week or the wide moat stocks we also buy each week as part of our wide moat strategy. I don't want it to make a routine of posting them each week if there's not much interest in them. Now in the green box in the upper left, note that I've added a note that those three strategies are newer and therefore the average investment has been held for less than a year. This means their annualized returns will fluctuate a lot until the holding period eventually grows. For example, the capital light strategy is by far the newest strategy as it was started on February of this year. As you can see on the bottom table, the average investment in that strategy, we'll talk about the capital light strategy, has been held for 72 days and has a return of 8.4% for an annualized return of 50.57%. Now the annualized return of 50.57% should be taken with a grain of salt. All it means is if a stock's price rises 8.4% every 72 days, then you get an annual return of 50.57%. And in the purple box, this is new. So I've broken out for the tech stock portfolio. I was wondering, well, which stocks are doing better, the dividend-paying tech stocks or the non-dividend-paying tech stocks? I thought it would be closer, but the dividend-paying tech stocks are doing a lot better. They're averaging 34.37% per year, and the non-dividend-paying tech stocks are averaging 11.44% per year. This slide is showing the portfolio value over time for our original portfolio, our dividend growth portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $3,200 after 182 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. We're buying fractional shares of stock. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Those usually have a yield of around 3 to 4% or higher. Now, on this chart, the tan line shows what the portfolio value would be if we'd instead put the money into a simple savings account. In our first year, 2022, stocks and bonds did poorly. As you can see, the portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November 2023 and in April of 2025. Now I'll update our tech stock portfolio in next week's video, which we started in late of April 2024 and has been the best performing portfolio over that time. And for those that have been asking, all three of the portfolios are now on our website, beatthestockmarket.com. We post the stocks we're buying in real time on Mondays. They're not delayed like in the video. When we make our weekly investments and anytime we sell a stock, as well as information about portfolio holdings and trade confirmations. Now, if you're new to my channel, I'm an accounting professor that teaches accounting and finance, and I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. Now, before we get into which stocks we bought last week, a lot of people have been asking me for my favorite books about investing. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis for 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. They are the Trending Value Stock Screen and Consumer Staples Stock Screens. I update the stock screens monthly. But if you read the book, you can figure out how to run the stock screens yourself. So what is a stock screen? It is just a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs, so if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own to save yourself some money. It's a much shorter book than What Works on Wall Street. I'll put the link to the 2 books in the description of the video. So now this is new. For investors who are afraid to invest when the market is near an all-time high and think they would do better by trying to time the market, you might want to reconsider your position. A recent report from JP Morgan shows that investing at all-time highs led to higher returns compared to investing on a random day for the time periods of 1, 3, and 5 years into the future. Now this is likely due to the power of momentum. Momentum is one of those things that lasts. I should say it's one of those strategies that has persisted over the years, even after people have started to use it. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. So SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, the average investment in our dividend growth classroom stock portfolio has an annual return of 20.04%. Now, if we had instead invested the same exact amounts into SCHD on the same exact days, the portfolio's return would only be 4.56% per year. our high yield portfolio is also outperforming SCHD. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our two dividend-paying classroom stock portfolios, being the Dividend-Growth and the high yield. I also prefer our actively managed classroom stock portfolio strategies rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection. It's just an algorithm that's picking stocks. SCHD has at times had large positions in stocks I consider to be value traps, and that's not a good thing. Now this slide shows our best performing stocks for our original portfolio, the Dividend-Growth stock portfolio, based on when they were initially purchased. Stocks in yellow, like Evercore and Crane Holdings, have been sold. Broadcom is in first place with a 384% return in 38 months. Evercore, an investment bank, is in second place with a 252.9% total return. It's been sold. The two worst performers were Atcore and Vestas Corporation. Fortunately, I only made one investment in each of the stocks, in each of those two stocks, instead of usually the average of about 7 investments or so into the stocks. But both are down over 50%. Now, those two stocks are categorized as under the radar dividend payers, as you can see some of these are. Only 8% of the investments so far have been invested in those under the radar companies, which are defined as companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. Now, the other 92% or so of our investments made in this portfolio have been in these dividend-growth companies. Those are companies that have a great track record of increasing their dividend payouts to investors. Now, despite some of the huge gains in the under-the-radar dividend payers, such as Crane Holdings 132% gain in 18 months, and F&G Annuities 117% gain in a little over 12 months. This category of stocks, the under-the-radar dividend payers, hasn't done nearly as well as the proven dividend growers. So I foresee us cutting back or eliminating our investments in these under-the-radar dividend payers in the future. So in the future, we'll probably just stick with the dividend growth stocks since they tend to be safer, less volatile, and so far their performance has been better. Now, this slide shows our best performing dividend growth stocks this last week. It does not include dividends. The best performers were Worthington Steel up a whopping 30.7%, Nike up 20.5%, and on Friday alone it was up about 15%. Finally, maybe this laggard will have a turnaround. Nike's not been doing well lately. And then we have Clear Secure, Nvidia, Taiwan Semi, Applied Materials, and Goldman Sachs, along with several others. And this slide shows our best performing dividend stocks this week for our high yield stock portfolio, which has far fewer holdings than our dividend growth portfolio. So it's not going to have as many stocks on this list. The best performers last week were Goldman Sachs, 7.8%, State Street, 6.4%, same with Sony Group. Then we got Morgan Stanley at 6%, US Bancorp, M&T Bank, and PNC Financial. And just for fun, here's this slide shows our best performing stocks in our tech stock portfolio last week. The best performers were Arista Networks, 15.2%. And then above 9%, we got Nvidia and Taiwan Semi. And at 8.1%, we got Applied Materials, Broadcom, Lam Research. So you can see a lot of the chip companies had a good week last week. So here's a usual disclaimer. This presentation is for informational purposes only. It is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So let's talk about the stocks, the dividend growth stocks we bought last week. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the top 10. So on this slide are my ratings for the top 20 dividend paying stocks, but again, we only buy the ones ranked 1 through 10. Remember, we use many criteria to filter stocks, and if a stock is hovering near the required level of a certain metric, the stock can make the list 1 week and then drop off the list based on a small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. Now, for consensus earnings growth estimates, I will only purchase a stock for this strategy if its earnings are forecast to grow at least 5% over the next 12 months. That's because I want to invest in stocks that can continue to increase their dividends for this portfolio. A stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the stock suddenly does not make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. Now, just because a stock doesn't make the rankings one week does not necessarily mean we will sell it. Each week when we list the stocks we're investing in, we will also alert you about any stocks we're selling from that portfolio. So again, each week we buy 10 stocks, and since we're investing such a small amount each week for this model portfolio, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account in cash. We then take that combined total and split it amongst the 10 stocks we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we're purchasing that week. Now, this table on this slide shows the company's sub-industry, how undervalued they are according to our research, their risk rating, their quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So my other brokerage accounts, I'm also investing these dividend growth stocks and the high yield stock in the next high yield stocks on the next few slides, as well as some of the other strategies like the wide moat and the capital light. Now last week I purchased over $3,000 of the stocks as I'm trying to sell off my SCHD holdings and reinvest in these stocks since they've been outperforming SCHD by a large amount. Now on this slide, I want to show the components to our quality grade. We've still got the same top 20 rated dividend growth stocks. Quality-wise, we only invest in stocks rated B- or better for this portfolio for about 92% of our purchases. The other 8% or so, as I mentioned before, have been invested in those smaller under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. So risk is the first quality component on this slide, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices as well as the quality or reliability of the reported earnings. Earnings, remember, is called just another fancy word for profits. And finally, the last quality component is financial health. Remember, the risk ratings are comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of those same top 20 companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out higher dividend yield rarely have the greatest potential for the greatest growth in those dividends, so don't chase yield. Now let's talk about our quality rating. One of the components is moats, a measure of competitive advantages. One advantage of companies with the best moats is if they pay dividends, they are more likely to increase dividends even during an economic shock when compared to companies with no moat. Now on this slide, Morningstar shows there are three categories of moats. On top we have companies with wide moats, which is considered the best. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends, despite many companies being in financial trouble. Only 18% or so cut their dividends. Now for companies with no moat, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats is a good place to start. Of course, this slide only covers the 3-year COVID period. Now, during normal periods, dividend cuts are much more rare, and on average, companies raise their dividends 5.5% to 6% per year. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have that portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Now, historically, dividend-paying companies raise their dividends 5.5% to 6% per year, like I mentioned in the previous slide, and that's above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, since our last video, we've had 2 dividend increases. Darden Restaurants increased their dividend by 7.1%, and America Movil increased theirs by 15.3%. Of the last 25 dividend increases, the average is 7.8% for this portfolio. Now, here's a look at the top 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in just the top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio. And many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst possible time. Like back in April when we had two days where the market went down 5% each. A lot of people panicked and they got out of the market. Well, since then, the market's gone pretty much straight up. So those that panicked and sold, and they're out of luck. Now, our portfolio holdings currently are 80 dividend growth stocks and 23 under the radar dividend payer stocks. And the weighting of those, if you just take the dollar amounts, 92% of the weighting goes to the dividend growers, and only 8% are allocated to the under the radar dividend payers. So you can see that this pretty much is just a dividend growth portfolio. And as I mentioned earlier, the dividend growers are performing better than the under the radar dividend payers. So going forward, I probably won't be adding many, if any, of the under the radar dividend payers. So it'll become more of a totally 100% growth stock strategy. Now, 80 dividend growers might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious, to us anyway, when to sell a company once we download company financial and accounting information in the spreadsheet, which we do at least weekly and doesn't take that much time. But it did take a long time to create the spreadsheet. Now, by comparison, SCHD, the popular dividend ETF that we compare our performance to, currently has 103 holdings. So just by coincidence, our portfolio has the same exact number of holdings as SCHD, but I foresee our portfolio holding number going down gradually in the future as we maybe trim some of these under the radar dividend payers. Now let's talk about our high yield dividend paying stock portfolio. Now I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annual total return so far of 21.72%. Currently, the high yield portfolio's dividend yield, if you waited until today to buy all the stocks, would be 4.11%. Compared to our dividend growth stock portfolio, the companies in this portfolio likely will not grow their dividends as fast. Therefore, this portfolio would be more geared towards investors closer to retirement. Now, having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks at a high price and reinvest into better bargains, pushing the portfolio's yield based on the amount we've invested to 4.76%. Now, 2 strategies are being implemented in this portfolio. as you see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1, in an attempt to try to get the best of both worlds, that being both a high yield and dividend growth. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 16.5% and has been held for an average of 238.5 days so far, which is an annualized return of 26.35% using Excel's rate function. Now let's talk about the high yield dividend paying stocks we bought last Monday. I get confused about which day was a holiday. Anyway, so let's talk about the high yield dividend paying stocks we bought on the first trading day of last week. There we go. I posted these rankings to our website, beatthestockmarket.com, and then we purchased these 8 stocks. There's going to be some overlap in the 2 different strategies. Now, one thing that's different about this higher yield strategy than our dividend growth strategy in the previous slides is we purchased only 8 stocks, and we have 2 different strategies within this portfolio, as mentioned previously. Strategy 1 emphasizes high dividend yield over dividend growth. Those are the ones in red, and the ones in green. Strategy 2 emphasizes a high dividend yield, but places a bit more emphasis on recent dividend growth than Strategy 1. So as you can see, there are a lot of duplicates, but not exact duplicates. I think we've had 1 or 2 weeks where they were exact duplicates. So the 4 high yield stocks we bought last week while implementing Strategy 1 are Comcast, Merck, Pepsi, and Novo Nordisk. And for Strategy 2, Comcast, Merck, PepsiCo, and PNC Financial. And the average dividend yield as of that day was 3.92%. And here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last week's grade for recent dividend growth and current yield, as well as recent dividend growth history. In the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields but a greater potential for excellent future growth in those dividend payouts. So if you want dividend growth, I suggest using a dividend growth strategy. Obviously, if you're looking for something with higher yield, this might be a better strategy for you. Or you can do what I'm doing, is I'm buying the stocks in both. So that's it for this week. In the comments, let me know if you have any questions. Also, let me know what portfolios or investment strategies you'd like to see more of. Finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, Substack, LinkedIn, and Twitter. I'll talk to you next week about our other portfolio strategies, like the tech stock portfolio, wide moat strategy, capital light strategy, and the sector rotation strategy I'm contemplating. See ya.